Okay, technical analysis. Technical analysis simply means uh, looking at price history or looking at price history to try to predict or determine what the future price of an asset would be. And in technical analysis, we look at charts. Charts, this is a chart for instance. A chart is a graphical representation of the price of an instrument. And the chart looks at time. So you have time on your x-axis and you have the price of the instrument on your y-axis of the chart. Now, time always moves forward. It never changes. It's constant. It keeps going forward. But then price can move up and down. Now, the goal of every trader is to be able to make money, is to be able to take advantage of this up and down movement of price, take advantage of this down and up movement, which is what we refer to as price volatility, for the purpose of making a profit. So, studying technical analysis enables a trader or an investor to formulate a strategy that can enable them buy low and sell high, or sell high and buy low, because that's the only way to make a profit in trading, which is the goal of every trader. Now, to understand charts, this chart properly, we'll first of all look at different types of charts. Now, for the sake of this class, I'll only review three, but they are actually much more than that. Now, for the sake of this class, there are three kinds of charts. The first and the most simplest one is what you refer to as the line chart. This is the line chart, and this line chart is drawn by taking the closing price of a particular time frame of a particular time, then using that to form a curve, which is this line that you see. So all these points that you see, the turning points, the up and down movement, shows you where price closed. So by looking at this, you can tell where price is headed to. So by looking at this, you can just tell from your understanding, okay, this price overall is going up. But in going up, it has ups and down, ups and down, ups and down movement. Now that's how price moves, but overall it's going up. This is the line chart. It's very basic, it's the simplest form of chart because it only takes into consideration one thing. And that one thing is, okay, for the last trading period, let's say our trading period is a day. So we change our trading period to 1 day. It means that for the last trading period, for each day, it picks the point at which the market closed. Meaning today, for example, uh, today is 4th of May. So let's assume price started at this point, which is okay. Let's look at where price started. Okay, price today opened at $270. Yes, this is correct. So let's assume price started around here for today, which is $270. Now, by the time price closes around here for today, which is around 305, then it means that for today, overall, market had this movement. So this is the line chart. It's very simple. It just tells you what the closing price is. Now, this doesn't have so much information, so traders want to trade a chart that has more information. So more research was going on, and as time went on, more and more different kinds of charts came up. But in the early days, the line chart was what everyone was using to. I mean, like 200 or 300 years ago when trading started. But now it's a little more advanced. So the next chart is what you refer to as the bar chart, which is this. Now, the bar chart has the same information that the line chart has, but it's a little more detailed than the line chart in the sense that it doesn't only show you where the price closed or where the price opened, it also shows you how far. It shows you the trading range, how far price went down and how far it went up before it came to eventually close in a particular place. So, for instance, here, let's look at yesterday's candle. So, for this candle, for instance, this particular one, this dot that goes backwards shows you that, okay, this is where price opened. This is the opening point of price. So price opened here, then went up, went this high, but then closed at this price where you have this bar. That's why it's called a bar chart, this bar pointing out. Now, for this particular day here, it means that price opened here, went all the way down, but then enough buyers came in and pushed it back up that it closed here. So once the opening price is lower, once the opening price, which is this, is higher than the closing price, it means that price overall for that day went down. In this case, when the opening price is lower than the closing price, it means overall price went up for that day. Now that's how, so looking at this now, you can see that it is more detailed than the line chart. The line chart only tells you where price closed. It only picks a point and tells you price closed at this point. Let's look at the line chart again so you see the difference. So the line chart only tells you the closing point, which is here, which is here, which is here for those particular days. But then the bar chart gives you more details. It tells you where it opened, how far it went down, or how far it went up, and where it eventually closed. Now, the bar chart was used for a long time until about 100 years ago that a Japanese trader was trading rice, came up with what you refer to as today as the Japanese candlesticks. Now, this is Japanese candlesticks, and it's actually the most popular in this generation, is the most widely used. Why? Because it is much more detailed than even the bar chart. The bar chart is good. All the information you have on the bar chart is also here on these Japanese candlesticks. Just that the Japanese candlestick has a little more detail. Now, as the name implies, candlesticks. So each of these bars, I call it a bar, each of these trading candles look like a candle. Each of these trading bars look like a candle. Why? Because it could have a wick, which is this, a wick down, a wick up, then it has a body. You know, it looks like your candle. Now, each of these candles, the way they close and how they close, the length of the wick up, the length of the wick down, the size of the body of the candle, all tells a story. And the story could also be formed with a combination the strength of the story can get clearer if you combine several of these candlesticks. When you combine like two or three of them, it gives you a different meaning. And now the line chart cannot do that for you. The bar chart cannot also do this clearly. Also, when you look at them individually, they have different names, and there's a psychology behind each of the candle. For example, this one that is very full, that has very little or no wick, shows you that on this particular day, there was a lot of buying power. That's why this candle is big. It's bigger than this small one. This small one tells you that, oh, market traded today, but it didn't really go up or down. That's why the body is small. Same thing for this one. It means that market didn't really move for this day. So the sellers are not really actively selling, and the buyers too are not really actively selling. So each of these candlesticks has a name. They have a name, or you can group them and give them a particular name. Then also there's a psychology behind what they mean when you see them at different levels of the chart. For example, this is called bullish engulfing. So they have a name, and each of the names play a role. Now, that is all for Japanese candlesticks. Now, the next, I would like us to look at time frames. Time frames. Now, I was saying earlier that your chart is a representation of the history of price, and you can use that to the predict the future of where price is going to. For instance, for instance, uh, okay, now each of these candles, you can look at your chart at different time frames. You can choose to look at it on the weekly, meaning each of these candles represent 1 week, a whole week, that's 7 days, or you can decide to look at it on the monthly, meaning each of these candles represent 1 month. Each of these candles represent 1 month. Now, whatever time frame you choose to look at it on depends on your investment, your horizon, the time horizon you're looking at. If you're a trader or you're an investor, you stick to different time frames. The very large investors that have a lot of money prefer to look at the monthly and the weekly charts. Then for people who trade actively, most times they look at the daily chart and the 4-hour chart, and sometimes even the H1 chart. Now, each of these candles, like I'm trying to explain, represent a time frame. So you can choose the time frame here. You can go as low as 1 second, 5 seconds, 15 seconds, 30 seconds, 1 minute, 30 minutes, 1 hour. You can look at it at different time frames depending on whatever strategy you choose to adopt. Now, let's continue. That's it about time frames. But for beginners, I always advise you stick to H4 or the daily time frame, because if you're looking at H1 and you're trading, it can be pretty stressful, because what this means is that you have to look at your chart every 1 hour. And looking at your chart every 1 hour can be stressful. Why? Because there can be so much noise in the course of a day. So if you have 24 hours in a day, it means that you have to look at your chart every day, sorry, at the close of every 1 hour. Meaning you have to look at your chart for, maybe you can decide to only check when you are awake, your waking hours. So let's say you are awake for 15 hours a day or 10 hours a day. So it means you have to check at the close of every 1 hour. Meaning if this is 8:29 and I'm trading on the H1, I have to check my chart when it's 8:55 or when it's 9 p.m. because that's when this particular candle will close. And how the candle closes tells a story too. And the level or where the candle closes also tells a particular story. We'll get to learn more as we go along. So that's it about time frames. So the next thing is to look at what we refer to as support and resistance. Now, support and resistance, uh, sorry, sorry guys, my network. Okay, now support and resistance is a concept that helps us identify uh, areas of buying activity or areas of selling activity. Now, as I go on, let me reemphasize that if a candle closes red like this, it means that this candle closed lower than where it opened. And what this means is that there are more people selling than there are people buying. So if you see red, 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 it means more people are selling and the price of this asset is going down. Then if it turns around and you start seeing more of blue, 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 it means more people are buying and this asset price is pushing higher. So what it means is that the people who are buying are saying that we believe that this thing will be more valuable in the future than it is now. So currently, let's say Litecoin around here was at $220. So the people that were buying were saying that, okay, we believe that in the future, maybe in the next 2 hours, the next 1 week, the next 2 months, the next 3 months, Litecoin will be more valuable than $220. So if we buy now, it is cheap. Then we hope that we'll be able to sell later when it gets to $320. Then we'll pocket $100 profit on each Litecoin that we buy. Now, that is the reason behind it. So they keep pushing prices and are willing to pay more. So the person that bought at 300 here bought because he expects that later in the future, Litecoin might be worth $400. So if there are more people buying than there are more people selling, the price will keep going up, until it gets to a point where there are no more people willing to buy. And they are not willing to buy because they believe that this asset at this point is too expensive. And because it's too expensive, they believe that the price should go a little lower. So instead of buying those, and so once there's nobody to buy, the next thing that will happen is those who had bought lower with the hope that they're going to sell higher, when it gets to this point and there's no one bidding or asking or willing to pay higher than what they bought, they might not decide, oh, there's nobody willing to pay higher, so let's just take this little profit that we have, or let's sell with a small loss. So as they start selling like they did here, this price starts going down. Why? Because as they are selling, those who are supposed to be buying to will be saying, no, this asset is too expensive. Let's wait to buy lower. Let's wait for prices to keep coming down with the hope that we'll buy lower. So some might even say, let's wait for it to get here before we buy. But then it doesn't get to their target. Other people say, oh, it is cheap here. I think we can buy here, and they start buying and the price is going up. So all these activities represent the war or the fight between those who think price will go up and those who think price should come down. So those who think price should keep going up are called bulls, and those who think prices should go down are called bears. Now, you might hear the term bullish or bearish. Bullish means there's a high tendency that price will keep going up, or that price is actually going up. Then bearish means there's a high tendency for price to keep going down, or price is actually going down. Now, this is how to use those terms. Now, this is a simple explanation or broad overview of the war that goes on between buyers and sellers that ends up creating this movement, up and down movement that you have on the chart. Now, let's get into what I now call support and resistance. Now, for for the people buying to choose a likely place where they think prices will bounce up, or for the people selling to pick a likely point where they think from here prices will begin to go down, then the concept of support and resistance came into being. Now, I'll use lines to illustrate the simple meaning of support and resistance. Now, let's assume this is a chart. And I told you previously that technical analysis is basically looking at the history of price and using it to predict what the future of price of an asset will be. So to look at the history of price, you use what you call, you come here, you get out horizontal lines. You can do this on Binance too. Just go to under Binance, your chart, look at Trading View. But I like doing this analysis on this platform called Trading View because their chart is better and it allows me to focus on a particular pair that I want to analyze. For example, if I come to Binance, there's a whole lot of distraction on this side. On this side, there's distraction on this side. There are different assets, 11% down. I don't want to see all that distractions. So I can decide to just make my charts. Uh, okay, let me look at the same Litecoin we're looking at. Okay, now this is the same Litecoin I was looking at, but now I'm looking at it on Binance. Now here, this is you can do the same analysis here. Now to do it on Binance, the same tools that you have uh, on this side here are the same tools you have on TradingView. So you can do it anywhere you choose. It's the same thing. The charts are the same. You can customize it however you want. So let's go back to TradingView. Okay, now this is TradingView, the platform for doing analysis. Okay, now I told you that technical analysis looks at price history. So now let's look at the history of this price. And we'll do that by identifying the levels where price was going to. Let's say, for example, price was going up, it got to a point, it stopped, it started going down, it got to a point and it stopped and it started going up. Now, all those key turning levels are very important. Why? Because they show you the history and the memory of price. So let's pick our horizontal line. We'll come here, click here, look for horizontal line. Let's pick this horizontal line. So we're going to try to pick the high points where price got to and fell, which one of them is this. Then let's pick again the low points where price got to and turned around. One of them is here. We'll pick our horizontal line again, place it here. Then these two lines I've drawn, this one I've drawn tells us something about price history. Now this line is at 156. 156. It tells me that at this level, price was dropping, but then when it got to this level, it stopped going down and reversed and started going up. So the next question is, why did it reverse here? Now, the simple explanation is it reversed because the people at this level, people who were buying felt, people who were selling felt this thing is too cheap now. Let's not sell now. Let's wait and sell later. Then those who were afraid to buy here came in and said, okay, this thing is very cheap here. Let's buy and push this price upward so that we can make a profit. So this point where price reversed is called the support level, support, S-O-P-O-R-T. So you have the support level. Now, price then gets up, moves up, then heads back to where it was coming from before, which is around this level. When it got here, a lot of people who were buying said, okay, at this level, in the past, which was on the, this date should be on the maybe 17th of April, of March, a lot of people sold here. So what is the probability that if price gets here again, those people that felt Litecoin as an asset is too expensive at $230, will they be in the market and will they be willing to push price down again? Will they be willing to push price down again? You know, so when you get here and eventually when it gets close to this former level that price was at and dropped, when price now moved back towards that level, moved from 130, 156, now moved to 230, and then started dropping again. Why did it drop? People who sold here before came out and said, okay, now this place is a high point. Let's get out of this market. We think we have made enough profit. So they started selling. So as they sell, price drop. So this area that price got to and started reversing down is called resistance. Resist, to resist. Resistance. So now you have your support, you have your resistance. So your support level is the level above price where price gets to and starts reversing. Then your resistance level is the level that is above price. Now, price is below this resistance level. Price got there and started to drop. Now, if you look at your chart, you will see many of such tiny, tiny levels. This is another one here. You can call here to a resistance level. Why? Because price got here, then started dropping. So that's how you now draw your support and resistance level. So let's assume that you are living in a house, you are the person, you are, this is you. Let's say this is you, this is you. This is you with your hands and legs. You're living in this house. Then this area is serving as a floor of the house. Then this area is serving as the ceiling or the roof of the house. Now, this floor may not be too strong, the ceiling may not be too strong, such that if you have enough jumping power, you can jump up, break the roof, and now stand upon the roof. Now, this floor too is such that if you have enough power, you can break below the floor, then stand at the other end of the floor. Now, this is support, this is resistance. So sometimes price breaks through resistance, and then this resistance now becomes the new support. Sometimes also, the selling pressure is so much that price breaks through support, then this area that was support now becomes a new resistance. Now, that is the concept of support and resistance. In layman terms, support is like the ceiling of a house, or the ceiling, sorry, is like the floor of price, while the resistance is the roof of price. Now, the resistance and support are not fixed, in the sense that they keep changing based on the what is happening in the market. Meaning, if there are a lot of people who keep believing that this asset will keep going up, it means that more resistance will be broken, this resistance will become support, and resistance will be broken again, it will become support again, until price keeps going up. So you have something like this. If this was your support, this was your resistance, let's say price came down to support, pushed above it, got to resistance, but then broke above resistance, came down. Now this former resistance that was resistant here has now become your support. Then price can now push up again, break through this place that was resistant before, retest it, then shoot higher. Now that is simple. Now uh, let's look at different examples on this chart of where price was able to do that. Now, okay, now this is a good example here. So here, this is your support, this was your resistance. Price fell from resistance, tried bouncing back, didn't go back, went up, couldn't break resistance, came back down to support. Then a lot of people bought in here, pushed it up, it got to resistance. Those who usually sell tried selling again. It actually came down a little. Then this time around, it broke through that resistance, which was here and here. Then it came down. This resistance now became the new support. This former resistance became the new support. Then price pushed up again, forming a new resistance level here. Forming, okay, let me clear all that. Forming a new resistance level here. Now this price again, for whatever reason, the seller sold heavily, price came down, but this time around, it respected this area of support. It did not break this support. It broke this support that was here, came down, but then it failed to break this support and it pushed up. Now, prices are around this resistance now. So the next question is, will it break it or will it start coming down? Now, this is the summary of support and resistance. Now, let's move into the next one. Now, support and resistance use, in this case that I'm explaining, use horizontal lines, meaning the lines are horizontal. But then we know that sometimes support and resistance is not always, does not always use horizontal levels. Sometimes it could be diagonal. Why? Because price is ascending, and as it goes up, it comes down, it's moving in waves. It's moving in waves like this. So sometimes a good support and resistance to draw is to draw a diagonal one that is slanted in the direction of price, or slanted against the direction of price. And I'll show you what I mean. So by doing that, you are now using what is called trend lines. So to do that, instead of using your normal horizontal lines like we picked here, this is resistance now. This area was resistance before. This area here was resistance before. Now this area is now acted as support today. I actually bought Litecoin here, went up. Luckily for me, I took profit before as I saw it coming down. So now, if you now go to, if you now decide to go to H1, H1 is a lower time frame. This is H4. So if you now decide to go to H4, you can now guess why this market is bouncing, why this market bounced off from here. Now, let me show you. The reason it bounced off at that zone particularly is because of this. Now, this area that acted as a small resistance is now acting as a support. Can you guys see here? It's now acting as a support. It acted as resistance here. Then price came back down to this area that acted as a resistance too, but price broke above it. It became support. So now price came down to this area that was resistance before. This area now became support. Price shot up. Now it has come back to this area that was resistance before. Now this area is now the new support. So what are we expecting price to do? To push higher and maybe break this area that is resistance, go up, maybe come back and retest it. Then if there's enough buying power for it to shoot up again. Now that is how support and resistance horizontally works. Um, okay, now I was going to talk about okay, sorry. Okay, now I was going to talk about the diagonal support and resistance. So in the diagonal support and resistance, it is called trend line. And to plot a trend line, you come to this area here, you pick this one that is called a trend line. See it here, it's called a trend line. You pick it, then to draw a trend line, you are picking the point of best fit, meaning you wait for market to form a support, for it to go up, for it to come down again, then you identify your second point. So you need 2 points to be able to form a trend line. Okay, so now this trend line here, I've picked the trend line. So now I'm going to draw it to my point of best fit. Then I draw it, I project it into the future. Into the future. Why am I projecting into the future? I'm saying that, okay, if this area was valid here, if price respected this area anytime it came here, then maybe in the future too, whenever price comes to this area, it might respect it. By respecting that means it won't break below it and instead go up instead. And so what do we have? Let me change this to yellow. So what do we have? We had our first point here. Price went up, came down. Then we had this second point here. So now we formed our trend line. So we projected into the future. So long as price comes down but doesn't break this trend line, it means that overall price is still pushing higher. So like here, it came down, didn't get to it, went up, came down. Can you see it came down here, touched on it, then went up a little, came down, touched on it, then went up a little. This the final time it came down, then went below it. So here now it has broken our trend line. So it means that if you are trying to buy before now you have to be careful. So depending on your strategy, you can choose to wait for price to break above this trend line again like it did here before you buy, or you can choose to buy at the other horizontal level. Now, this trend line here was acting as a support. Sometimes trend lines act as resistance too. Now, let me look for a good example on this chart and show you guys. Okay, now let me show you this particular one. Pick your trend line. So for this situation too, you pick the point, then you wait for price to retouch it, which let's say it did here. Then you drag it into the past, sorry, into the future. This time around, you're dragging it against price. You're dragging it against the slope of price. So now it came down. Now this line is acting as a resistance now. It came down, pushed down, came to it again, pushed down, came to it again, pushed down. Now, the time you considered your signal to be a value to buy is when price now pushes up, breaks this trend line here, then retests it, then pushes up. Now, this trend line now is acting as your vertical resistance level. Now, the final one we'll do and end it for today is what I refer to as moving averages. Now, your moving averages are another form of support and resistance, but they are referred to as dynamic support and resistance level. These first two, the horizontal support and resistance level, are static, meaning they are fixed. They don't move along with price. They only expect that when price comes there, price will try and respect it, touch them, either break them, or by disrespecting them, the levels or the lines, or respecting them by failing to break them. In this case here, it broke the the vertical resistance. When it breaks it, it means it disrespected or disregarded that resistance line at that point, now went up. If it breaks a horizontal resistance level too, you can say it violated or disregarded or disrespected that level. When it comes down and fails to break below, you say it respected it. Now, trend lines, now before I add trend lines to the chart, now, okay, um, on TradingView, you can decide to delete all the lines I've drawn on the chart by just coming to this bin sign. Click on this bin sign and all the lines will disappear. Now, to add trend line to my chart, I come to my chart, then I go to indicators. This F sign is indicators. Then I type moving average. Moving average. There are many of them, so you just pick moving average, not the exponential. Different of them means different things. They mean they have different calculations. So I picked this one, moving average. I've picked it. Now I want to edit it to fit the strategy that I use. So after I picked it, it will show the default one, which is 9, which is this blue line that you see, Now, when they say a moving average is set to the period, so you come here, click on settings, then you want to look at the parameters. Now, the length of the moving average or the period of the moving average is 9. Then it is applied to the source. The source from which it calculates its length is at the close of that candle. So you put it at close. It could be the high of the candle, the open of the candle, the low of the candle, or the high and low of the candle divided by 2. But we don't want all those complexities. We just leave it at close, then okay. So what this 9 means is that it calculates the closing point of the last 9 candles, meaning it adds, let's say for instance, if we are calculating the 9 moving average, we will take each of these candles. This is the first one, this one that just formed. This is the second one, 2, 3, 4, 5, 6, 7, 8, 9. So the closing point of these 9 candles, when we add all of them together and divide it by 9, just like finding simple average in school, if they say find the simple average of 10 numbers, they give you the numbers. So you add all those, sorry, of 9 numbers. Let's say one was 3 plus 5 plus 2 plus, you add all the numbers together, then divide by 9. It now gives you the moving average at that period. So for instance, this guy is at 309. It means that this last candle closed at 309. Sorry, 307. So that is candle 1. So that is candle 1. So we'll now add the previous candle. We looked at where it closed. It closed here. This should be around maybe 290 something. Then plus 290 something. Then we'll count backwards up to the 9th candle. So let's say they had different numbers up to the 9th candle. Then we'll divide by 9. So the answer that we get is the moving average at this particular point. Now, on this chart now, let me show you this. Okay. Okay. Can you guys see this figure here? This is 295. What it means is that it is saying that this moving average, which is this blue line, is currently at 295. It means that if you add all the previous 9 candles, if you add them together and divide it by 9, it means that the slope currently is at 295. So that is how you came about this line. Now let's go to the one that I use in my strategy. So to get to that one, you come here. After adding the moving average, after searching for it and adding it, you come to it, then edit it. I use 50, simple. Then I can make the color to something that is very visible to me. I make it a yellow line. I make it a yellow line, then I make the yellow line thick. I make the yellow line, then I make the yellow line. I can change the thickness that I want. So I make it thick. So this now forms part of my strategy. So this is a 50 simple moving average. And the same way you calculated the 9 moving average, this one now, you now count the last 50 candles, the closing price of the last 50 candles, you divide it by 5. That now tells you the slope of this moving average at this point here. At this point here. Currently, that slope is at 268. So That is a moving average. And this moving average is a dynamic, it acts as a dynamic support and resistance. Unlike the other ones we reviewed, which are static, which are fixed, like the horizontal, we have a horizontal resistance somewhere around here. Somewhere around here, that's support rather. We have another resistance around here. We have a support right around here. We have another support right around here. Now, these are static. Then we did the trend line, which is vertical. Trend line, where is it? Trend line, no, trend line. Trend line will pick this point, then project into the future. You pick the tip of this point, the next point, you can even pick here, next point, then project into the future. Now, both these horizontal resistance, horizontal support, diagonal support, then the other one which I showed you was um, diagonal resistance. These are static. They play a very key role. They are important, but then these moving averages too serve a role that sometimes complements this horizontal and vertical support and resistance levels. Sometimes it complements them. They are supposed to complement each other. Now, as you can see, in different scenario, if you look at the past, this yellow line, which I like to call it as a market baseline, acted as a form of resistance. Like now, you broke below, price broke below it, retested it, failed to break above, came down, retested it again and dropped. Consolidated here, then it broke above this yellow uh, dynamic resistance level. You know, when price is below it, is a resistance, it acts as a dynamic resistance. When price is above it, it acts as a dynamic support. So price broke above it here, then it now served as a form of support, dynamic support for price to move up. So long as this yellow line is still slanting up and price is above it, it means that my dynamic support and resistance is telling me that this market overall is heading up. So I should be looking for buy opportunities. So this yellow line is called a moving average, and it acts as a dynamic support and resistance level. To confirm that, let's take another quick look at it. Let's scroll to the past. As we're scrolling to the past, we can see areas in the past where on this pair it acted as a support. See here now, it acted as a support. When price get there, it did not allow price to break below. Price respected this level, went up. Price came back again here. Sometimes it doesn't have to touch it. Went up as a resistance. All here, it acted as a resistance. It didn't allow price to just break above. Now, when price broke above, see how far it went. So that is your that's how the dynamic resistance and support levels work. Now, there are different kinds of moving averages depending on the settings and what you are programming them to calculate. So I've come to the end of this class. I'll stop here for today, because right now, after listening to so much of this technical